It's over. It's all over. That is the consensus I am feeling out there on Wall Street right now. The amount of people I see go on CNBC and other big financial networks and are basically talking about the rally has now run out of gas and we are headed back down. It's a large portion. Also, the consensus I'm getting from most folks that are retail investors is also they believe the rally is fizzling out as well and we are headed back down. And so I thought that there's so many people that are so confident about this. I thought, let's kind of speak about this. Let's run through things. I want to show some things in this video that are very important. If you're trying to figure out if the market rally is going to fizzle out or not, I'm going to show you some very important things in this video so you can kind of get some context around that. And the way a lot of people look at this is they say, okay, you know, a ton of stocks have gone up between, let's call it 15% and 50% just over the past 6 or 7 weeks. And so a lot of people are looking at that and they're like, yeah, I have to pay substantially more if I want to keep buying these stocks than what I had to pay just, you know, a few weeks ago essentially. So why should I buy now? Why not just put myself in a situation where if the market's going to fall more, I'll buy then, right? And so that's where today's video really comes from, is this overall feeling of just, it's over, man. Like this rally, this short-term sweet rally we've had, which has been sweet, off the bottom of 10.5 or so for the NASDAQ, climbing up to getting pretty dang close to 13,000. It's been quite an epic rally. And I mean, you know, one of the stronger short-term rallies I've personally seen in my 14 years of being in the stock market. Like this is a pretty, this is definitely up there with some of the strongest short-term rallies I've ever seen, to be quite honest. But the belief is that we are just going to head back down, 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 down. And then we're going to be back at 11K, maybe 10K NASDAQ here just in a few months from now. So yeah, I hope you guys enjoy this as always. There's a view of the market that is very similar to, my first car ever was a 1977 450 Mercedes-Benz SEL, okay? And this car was so ratted out, it was probably worth less than $2,000. The seats were all torn up in it, like the leather seats had all come off, so I bought these cheap little things from Walmart to like go over the seat, because otherwise you'd get out of the car and there'd be just all this like grinded up leather all over you and whatnot, and I had to drive my girlfriend back in that thing back in the day. It had no AC and I lived in Arizona, but when that car, when you hit the gas pedal, not much happened, man. It went real slow. But once you got up to about 70, it really started roaring, okay? And people have a very similar view on the stock market that, you know, when you're coming out of, let's say, a crash scenario, at first it's kind of like slow, slow, slow. Then you start moving. Once you get a little momentum going, it's like, whoo, you take off, right? And that's a view of the stock market. And it's usually pretty much right in terms of coming out of a crash scenario. You kind of just get a little momentum, and then that little momentum starts turning into more momentum, and it's almost like a snowball going down the hill. Or my old Mercedes back in the day, that baby, once you got it up to 60 or 70, that's when it really started rolling, okay? And it's kind of what goes on in the stock market, okay? Now, I want to kill this idea right now, okay? There's an idea that retail is running wild again, and they're causing all these stocks to go up massively, right? For instance, AMC just made some massive move here recently, and the stock went up like 70+%, okay? And this is actually something I see from like Wall Street, like a lot of folks that work on Wall Street try to say stuff like this. I'm like, that's not... They're completely clueless if they think that's retail that drove that stock up, okay? That is not retail. That's big money came in AMC, and they flushed that baby up over the past, let's call it a week or so. It's not like retail magically had all of a sudden all these millions and tens of millions and hundreds of millions of dollars on the sideline, and all of a sudden they're like, let's flood into AMC. It's not the way this worked at all, okay? Let's be very clear about that. So, you know, I think, in my personal opinion, a bunch of funds got in here, and they took this baby on a ride, and it has gone on a ride. Like, that is an absolutely massive, colossal move. The thing with AMC nowadays, that's a $13 billion+ market cap. You're not moving that unless you've got massive money coming behind it now, because that's not a small market cap. Back when that was a $1-2 billion market cap, totally different scenario. Nowadays, at a $13 billion market cap, I'm telling you, you have to have major money coming behind that baby if you want to make it go up 76% in a matter of, let's just call it a week or two. Come on, man. So, you know, that's something I see out there, and it's just, it frustrates me because they like to try to say, oh, it's retail causing these crazy movements in some of these stocks, like an AMC. No, is there a ton of retail that's in that stock that's holding, you know, some people holding $500 of the stock or a couple $1,000 of the stock? Sure, there's a ton of those folks out there. But that move right there, that was not retail. And I 100% guarantee you that was some big money came behind there and boom, 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 boom. And maybe they had been kind of accumulating for a bit, right? And then all of a sudden you throw a little bit bigger money behind that, then you can get some upward momentum. Then you can also get retail to hop on the back of that as well. And it just kind of helps get that last little extra push. Let's just call it up the charts there, okay? Wall Street does these sorts of tactics all the time. All the time, man. This is nothing new to them, okay? They do this type of stuff, okay? Now, I saw this tweeted recently, about a week ago or so. It said 6.3 out of every 10 options on the tape today, on that particular day, are calls. This is a year-to-date high and approaching levels seen during the retail option craze of 2021, okay? So, once again, retail is a part of the options market, okay? But let's be honest, the more sophisticated investors are far bigger element to the options market than retail is. And so this is like, it just bugs me how these different publications and whatnot, they always want to say, oh, retail's doing this, retail's doing that. Look at these idiots that are retail investors, when they have no clue, like, who's actually doing the moves and who's actually moving these stocks and who's actually doing all these options. Most retail investors don't even know what the flipping option is, okay? They have no clue. To sell a covered call or, to buy a put or buy a call. Like, most retail has no conception of that. They don't even have their account set up to do options, okay? But like they like to put this false notion out there, so it almost makes like Wall Street look like smart money. So then if these trades fail, they say, they always make it look negative any way you want to touch it, okay? If let's say this market all of a sudden goes down, then they say, oh, look at stupid retail. They bought all those options there and look at they lost. It's all, how clueless are they? And if the market goes up, they're like, oh, retail's just being crazy. It's just a short-term crazy pump by retail. And it just frustrates me because it's just lie after lie after lie after literally lie told by, Wall Street and by these big publications constantly. And it's like, dude, like most retail doesn't involve themselves in options in any substantial way, okay? That's a Wall Street game, okay? Is there some people that do options on the retail side? Sure. But the people that do options on the retail side, some of those folks might do, a trade every month from an options perspective. Like, come on, man, you're acting like retail's like running the whole market or something like that. Give me a break. That's not the way this works at all, okay? No. In regards to put and call ratio, this is an important thing to look at if you want to judge if the market's getting overly, let's just call it pessimistic, or overly optimistic. Okay, and the put to call ratio, basically the way to think about this is when you go over a 0.8 put to call ratio, you should always have more calls than puts out there in the market. But when you go over a 0.8, you're basically setting yourself up in a market that's likely getting way too pessimistic, way too bearish, and you're actually starting to take a risk of the market flipping. Okay, it doesn't mean it's going to happen right away, but it's just kind of like a telltale sign that likely within a few weeks, maybe a month or so, you're likely going to get a flip on the other side, okay? Especially if you've seen it continuously several times, which is exactly kind of what we saw, right? We saw several bumps in May and into June. When you keep getting those bumps at over a 0.8, generally speaking, it's kind of forecasting that we're about to have a flip in the market, okay? Now, also when you get under a 0.6, put to call, that sometimes can be a sign that the market's getting, let's just call it, too optimistic, and you're probably setting up for downside risk ahead, okay? And that's just kind of the way to think about that. Now, recently, right, we have several trading days, day after day after day, that are, let's just call it under 0.6. So I think that is setting the market up at least into a situation here where we could definitely have some downside risk ahead, given that people are just getting, when I say people, once again, I'm not talking about retail, I'm talking about Wall Street, okay? That's who's running the market. People think it's retail run the market. No, this is not retail run the market. Retail doesn't run the puts and calls. It's Wall Street, okay? Let's be very clear about that. They're the ones with the big money. They're the ones that are doing all these trades. And so the market could be setting up for some potential downside because people are just getting too, let's just call it optimistic. And once the market starts to potentially go down again, whenever that is, you'll start to see put to call ratio go up and up and up and up and up. And that's just kind of the way it plays out. Now, something interesting happened. So June 10th, The put to call ratio went to like 0.9, almost 0.89, which is incredibly high, and that's the highest we've seen at any point in the past 6 months. And that actually, I think that's the highest we've seen in the past year as well. Very, very high. And, you see something like that, you got to know you're likely, and especially when you continually see put to call ratio that high, you likely got a flip coming. And it's interesting because, I did a video on that exact same day. I called it buy the dip and don't stop. And I went into, I was buying all these stocks and things like that. And there you were in a moment that it was giving you such a telltale sign that the market is getting far too pessimistic. And we had already been crashing. Like the NASDAQ as of June 10th was already down 30% plus year to date, which was just ridiculous. The Russell was as well. The S&P 500, I believe, was in bear market on that particular day. I think the Dow was right around bear market on that particular day or that week. And so you were in a moment in the market where there was just far too much pessimism in the market. And when just everybody goes bearish, you got to go to the other side, man. You got to go to the other side. And the same thing, actually, when everybody's bullish and everybody just has positive things to say about the market, that's when you got to start saying, oh, crap, man. And I think I might need to cash up here a bit. I think I might need to maybe sell some stocks. It's the way it goes. And it's been the story of the stock market the last 100 years. And here we are in 2022, and it's still the same story again and again and again, okay? Now, Apple's a real risk to the stock market. I mean a real risk. And if you want to think about the indexes potentially being hurt, you have to, it really starts and ends with Apple, okay? Apple, here's the deal. It's climbed significantly off its 52-week low now at this point in time. It's still $14 away from its 52-week high, but the stock's trading rich. It's trading at 27, 28 P ratio. The forward P, we don't really know because it's very possible Apple's profitability could actually decline over the next, let's call it 4 quarters. We'll see what happens with that, but that's very much a possibility. So it's very possible that the forward P for Apple right now is potentially higher than the trailing P, which would be a whole disaster in itself, okay? So this stock is trading very rich compared to how it usually trades in the market. It's much closer to 52-week high than 52-week low. And we got problems here, okay? So the September quarter, which the company would not even give guidance. Tim Cook and the executive team, they don't even feel comfortable giving guidance right now because their business is in a tough place. Basically, Apple's business, in a matter of a few quarters, went from a company that was destroying estimates, beating their revenues by billions and billions and billions of dollars, destroying their EPS and their margins and just tearing it up, to also in this past quarter, we see some numbers starting to decline. We see some very slight beats on numbers. And all of a sudden the story went from this is amazing, look at what Apple's doing, to all of a sudden literally this past quarter, it's like, oh boy, are we about to go negative with revenues? Are we about to go negative with this? And everything's just completely starting to deteriorate massively in their business model. You look at the iPhone numbers, you look at the services revenue, you look at iPad, you look at Mac, you look at all these different things. And everything is showing deterioration and it getting worse and worse, and it actually very, very rapidly here for Apple, okay? And so I think there's a real question if Apple, whoa. I think it's a real question if Apple's even going to grow in the September quarter. I think that's a real, big question mark, okay? The current year, the company is expected to grow by analysts, the 35 analysts that cover this stock, to grow 7.3%. I think that's in a big question mark right now. Let's just put it that way. And next year, the analysts have this company growing 5%. I think that's a huge question mark. And, I remember back on Millennial Money back in the day, I used to always bring up the middle class, right? And I'll say it again. The middle class runs Apple. I don't care what anybody says. The middle class runs Apple. That's who's buying all these iPhones. That's who's buying all these Macs. That's who's buying all these iPads and these AirPods and all these things and spending all the money on the App Store. And if the middle class is getting sliced and diced and really hurt by inflation, they can't go buy that next new iPhone. And you say, well, there's always the rich people are always going to buy the new generation of iPhone. Sweet. That's true. That's probably true. I mean, if the rich people stop buying the new iPhones, then Apple's really in trouble, right? But the problem is of the percentage of revenue for Apple, the amount that comes from actual rich people is a very small amount. That company is run by the middle class. Let's be very clear about that. And so if the middle class is not in a financial situation where they are in a position to upgrade this next cycle, Apple's not hitting their numbers, okay? Bottom line with that. And so that puts the company kind of at jeopardy here in the short term, right? And we know Apple's a beautiful business model for the long term. We all know that, right? But if you're thinking about a risk to the stock market, it starts and ends with Apple because of what is likely going on in their business model and what's likely going on in the overall economy right now, right? Now, here's why it matters on a much more significant way. Apple makes up almost 7.3% of the S&P 500. Microsoft makes up 6%. Okay, there's 13 stocks that make up 1% or more. So basically, here's the deal. If Apple and Microsoft stock go down, the whole market's going down. It will pull down the entire S&P 500. And the S&P 500 falls, it brings down Russell, it brings down Dow, it brings down everything, okay? Those two babies really run the market. The middle class runs Apple, okay? And Apple runs the stock market. And so Apple has been a great help to the stock market over the past decade, let's call it 10 to 15 years, because companies just got bigger and bigger, and it just, they did an amazing job with their business model and just got bigger and bigger. And as the company grew, it helped out the entire stock market. But it's a real risk that Apple could hurt the stock market. And also keep in mind, there's companies, right? Like a Berkshire Hathaway, for instance, that is a huge weight. Like look at Berkshire Hathaway is the 7th, and if you want to add up Google, it's really the 6th biggest weight in the S&P 500. Berkshire Hathaway has such a huge position in Apple nowadays that really their stock price can be determined upon how Apple's doing at a particular time. And so that's even a whole other big risk out there, right? And then you think about Google. Google's got a whole big legal situation that's about to happen here, okay? And that's a big deal for Google McDougal. So Google's a risk for the market, right? Tesla's done an amazing job, but can they keep putting up those great numbers? I don't know. We'll see about that. But the bottom line is these two companies run the show. It gets even worse, okay? It gets even worse. The NASDAQ 100. Apple has a 13.4% weight for the NASDAQ 100, okay? There's 22 stocks that make up 1% or more of the weight in the NASDAQ 100. Mr. Softy, Microsoft, makes up over 10% of the weight in the NASDAQ 100. These two babies run the market. And if they are hurt in any way, and if their stocks go down in any way, they pull down the whole dang show. Okay? The bottom line. Now, if their stocks go up and Apple grows way better than everybody anticipated, and it's like, woo, to the moon, that's going to pull the whole market up. But I just have real questions about that, given the environment we have with the middle class. And even if, I don't know if this next iPhone is going to be a game changer at any point, in any way. And so unless that's so amazing that everybody in the world is like, I got to get the newest iPhone, I just don't know, man. I have real questions about that. And we saw things start to get a lot worse for Apple in this past quarter. And based upon what these other companies are telling us that we're about to get into, I really think Apple revenue is going negative. I really do, and I think it's just a matter of time here, okay? Now, the AAII investor sentiment has flipped massively, and I mean massively. So if you go back, a month or two ago, we were at these numbers of like less than 20% of investors were bullish, which is another sign that the market's far too pessimistic. When you start coming in with week after week after week of like less than 20% of investors are bullish on the market for the next 6 months, you're setting yourself up for a flipping situation here. Look at this. 1, 2, 3, 4. You had 4 weeks out of an 8-week span, a 7-week span there. There was under 20% of investors were bullish on the market for the next 6 months. It's usually a pretty safe bet that you're about to flip in the market, and that's exactly what we've seen play out. But now we're all the way up to 32.2% of investors are bullish on the market the next 6 months. So now all of a sudden we're setting ourselves up for, oh man, everybody's jumping over the bullish side now. Okay. Bearish side. I mean, look at this. At the peak, 59.3% of investors were bearish on the market the next 6 months on June 22nd. 58.3% of investors were bearish on the market on June 15th. When you see that many people bearish, you got to know the market's likely to flip. The problem is now for the market, at least in the short term, is a lot of those bears have flipped over to the neutral or to the bullish side now at this point in time. And now only 36.7% of investors are bearish on the market the next 6 months. So we've had a major flip there. And that just kind of shows you that we're going to likely start to run out of gas here because you're already getting the flipping to happen. And maybe we can get over to a much more bullish standpoint, but it's going to be difficult to get there, okay? okay? It gets even more difficult when you see stuff like this. NVIDIA just missed their Q2 projections by $1.4 billion. The company had a preliminary come out with numbers, and it's just a disaster. Just a complete disaster there for NVIDIA. It's not good. And NVIDIA is a pretty heavy weight in the market, and so NVIDIA is just showing us that consumers are pulling back big time. They're pulling back big time, and likely not because they necessarily want to, but for a lot of these situations because they have to. I mean, if all your money's going toward oil, gas price over the course of this summer, and your money's going toward food and things like that, it's not an ideal situation, bottom line, okay? Then we got this yesterday. Micron, which is one of the bigger memory chip companies in the world, basically whatever device you're watching us on right now, whether you're watching on a phone, or whether you're watching this on a tablet or a PC or whatever, or maybe you're watching this on the TV, and shout out to the TV squad. Let me know if you're doing that. I think only a few percent of folks that watch my videos actually watch on the TV. That's kind of cool. But it doesn't matter basically what device you're watching this video on. It's got memory chips in it, okay? And Micron's one of the biggest players in the memory chip category. And Micron's warning adds evidence to collapsing chip demand. Memory Maker warns it's not just PC makers cutting inventory as well, which is kind of a scary thing to hear. So yeah, Micron's warning business is very weak. NVIDIA just missed by $1.4 billion. And it seems like earnings are deteriorating for these companies in a massive, massive way, okay? I mean, just look at it. And I think something you always got to ask yourself in a situation is, are earnings getting better or worse? Like what does it seem like? And for me, what I've seen is earnings getting far worse for companies. Companies are, I've seen a ton of companies miss, or if they haven't missed, they basically barely beat by like an inch. I haven't seen any company other than maybe Tesla, really come out and tear up their estimates and tear up their numbers. And it's a poor operating environment. I probably listen to 30 to 50 conference calls every earnings season, okay? And every single conference call I listen to, I don't hear anybody super bullish on the state of the economy other than maybe the bank CEOs. Outside of that, none of these other CEOs have necessarily great things to say about the macroeconomic landscape right now. None of them. And so, they're looking at their business on a day-to-day basis and like, it's not super strong right now. Let's just put it that way, right? And so it seems like, if anything, things are getting worse rather than better when it comes to companies' earnings, okay? Now, this puts us into a situation where the market's going to be in no man's land right now. I call it no man's land because the market's going to be very confused on which direction it should go for the next a little bit of time. Let's just call it that. Because we don't have anything major coming out, like I'm talking about major for quite a while. Here's the deal. The next CPI numbers, that's going to come in a month from now, the August CPI numbers, okay? We have no big company earnings for the next 2 months. We still got a bunch of smaller companies and some mids to report over the next few weeks. But in terms of those big dogs again, the Apples, Googles, Microsoft, Meta, Amazon, all those big dogs, they're not reporting for another 2 months now. So we got to wait 2 months for all those big guys to report their earnings again, okay? Midterms are like 2.5 months away, so that's still a while away. The Fed's likely not going to come out with, what they're going to do with it, the Fed funds rate for likely 2 months. You're going to probably hear a bunch of commentary from different Fed officials and things like that. But in terms of actually making a move, we're likely not going to get that for another 2 months. So the only question is, do we get any surprises in the meantime? Any companies that come out over the next, let's say, month and say, hey, we're missing our numbers as well? It's always a possibility. That would be kind of like a little bit of a shock and awe event. Let's imagine an Apple comes out and says, hey, our numbers are real bad. We're not hitting numbers. If something like that happened, then the market would have a narrative to go off of. But for right now, the market really doesn't have a narrative to go off of for the next, I would say in the next 4 weeks, until we get that next CPI number and we see if things are getting considerably better or worse or about the same when it comes to CPI. So we're in no man's land right now, the bottom line there, okay? Now, my 2 cents on this, if I look at folks, okay? One is, I understand like shorting can look easy because it's like, we're going to have to go back down in the market. It looks a lot easier than it actually is, okay? And just because you could potentially go down in the market doesn't mean it will happen, okay? And remember, the stock market likes to look to the future a lot. So, let's say earnings are weak in the fall quarter, whenever all these big companies report in October-ish. Okay, sometime around there. It could be scary. It could be Halloween. Okay, it could be scary. the market could look past that if they feel like the Christmas quarter is going to be strong or early 2023 numbers, because the market's usually always looking anywhere from 3 months to 9 months into the future. That's just usually the way it works. So you really have to see more of a deterioration and even more worrisome commentary from company CEOs out there that would make the market go down a lot more, right? But it's not given that that's for sure going to happen. So just I've seen it consistently. Like shorting looks really easy. It's just you got to understand, man. You are playing with fire. You never know what the Fed can do. Could the Fed pivot? Maybe not. I don't think so. But you never know. The Fed surprised people a lot in the past. Okay, so it doesn't mean they can in the future, right? Number two. If we drift higher and you're super low on cash, I think it's a good time to cash up. I really do. And that's obviously something I'm doing right now. And I've been doing pretty much for the past month or so. It's just kind of like cashing up, man. Instead of putting income straight into the market like I was doing when everything was crashing, now I'm just kind of like, okay, let's cash up here a little bit, right? And yeah, as we drift higher, let's say we continue to drift higher, and you're out there buying. You need to just be mentally prepared that we could fall back down, and your stock, whatever you're buying your stock at now, it could be 10, 20, 30, 40% lower, a few months from now. So as long as you're mentally prepared for that, I don't think that's a problem. The problem is a lot of people in the stock market, at least, folks that maybe are not as experienced, they buy into stocks and they're not mentally prepared for that damage, right? And obviously a lot of the crowd that got in late 2020 and into early 2021, a lot of them were not mentally prepared for what was likely coming, which was some huge drops in stocks. And obviously, starting in November of 2021, we had a massive drop in the entire market all the way through June of 2022. A lot of people weren't mentally prepared for that. If you're mentally prepared for that and you're understanding you're going to buy, let's say you buy Apple stock at 175, and then Apple's next earnings aren't good, the whole market starts to deteriorate again, and Apple goes down to 145, 135. As long as you're mentally prepared and you're okay with that, fair play. But you just got to understand, like, that's part of the game, and you're in definitely a market that's still, let's just call it on quicksand a little bit here. Okay, that's the best way I could kind of describe it. It sounds a little rough, but that's kind of what we're on right now, right? Number 4 thing you could do is, if we drift lower, you can just add to your favorite 3 to 4 stocks. So let's say the market is, since it's in no man's land, let's say it just drifts lower and lower and lower for the next, the next few weeks. You could add to your favorite 3 or 4 stocks, as long as you understand and you're mentally prepared that those stocks could be lower, and you're prepared to buy those stocks, and you're in a position where your income's more than your expenses. Because as long as your income's more than your expenses, you're always in a situation where if the market drops back down, let's say NASDAQ goes back down to 10,000 or so, you're in a position that you can buy as stocks kind of crash, and you're not in a this is called a position of weakness. You're in a position of power. So I definitely think that's something you can do out there, and that's my 2 cents on that. So yeah, hope you guys enjoyed this video. As always, if you're looking to scale your portfolio to 6, 7, 8 figures and beyond, if you want access to my private stock Discord chat, you want access to my courses like Dividend Investing Mastery, Become a Master of Stock Market, and all the other courses, if you want to understand income statements, balance sheets, cash flows, all on a super high level, as well as get access, to all the 6 and 7 figure members and things like that, go ahead and apply for the private stock group. That will be pinned comment down there, and we'll see if we can get you in there. Much love as always, and have a great day.